Have you ever wondered why your credit card bill always highlights the minimum payment? It seems helpful, right? A small, manageable amount. But what if that small number is actually the key to one of the most effective financial traps ever designed? What if paying only the minimum isn't meant to help you, but to keep you in debt for years, sometimes even decades? Welcome to Money Trap Files. In this series, we pull back the curtain on the hidden systems designed to quietly separate people from their money. Today, we're opening our first case file, the minimum payment credit card trap. So, how does this trap actually work? When you make purchases with your credit card, the bank sends you a statement at the end of the month. On that statement, you'll see two numbers: your total balance, and a much smaller number, the minimum payment due. This is the smallest amount you can pay to keep your account in good standing. Most banks calculate this minimum payment as a small percentage of your balance, usually between 1 and 3%, plus any interest and fees. When money is tight, that small number can feel like a lifeline. But in reality, it works more like a leash. Let's look at a realistic example. Imagine you have a credit card balance of $3,000. It's a common situation, maybe from a medical bill, a car repair, or just everyday life expenses. Your credit card has a typical interest rate of around 22% APR. Your minimum payment is calculated at 2% of the balance. That means your first minimum payment is about $60. Sounds manageable. But here's the part most people don't realize. Out of that $60 payment, only about $5 goes toward reducing your actual $3,000 debt. The other $55, that's pure interest. Money going straight to the bank. You've barely made a dent in what you owe. Month after month, the same pattern continues. You keep making the minimum payment. You feel responsible. You're technically doing everything right, but most of your money isn't reducing the debt. It's feeding the interest. Your balance slowly moves down at a glacial pace. So what happens over time? If you continue paying only the minimum on that $3,000 balance, it could take over 23 years to pay it off. 23 years. And during that time, you may end up paying more than $5,700 in interest alone. That means your original $3,000 debt could end up costing you nearly $8,700 in total payments, all while you were following the rules. So why is the system designed this way? The answer is simple. Banks are businesses. Their product is money. And they make profit when people borrow money and pay interest over time. The longer someone stays in debt, the more interest the system collects. The minimum payment isn't really designed to help you get out of debt quickly. It's designed to keep the system running, to create a steady, reliable stream of income for the lender, built on your debt. The truth is, the financial system isn't always your friend. It has rules and structures that can work against you if you don't fully understand how they operate. The minimum payment is just one of many traps hidden in plain sight. But once you understand how these traps work, you can start avoiding them. You can start taking back control of your money. Because the first step to escaping the trap is recognizing the game. Thank you for joining this investigation. If you want to uncover more hidden financial traps that affect everyday people, subscribe to Money Trap Files. Our next file is already waiting. A new Money Trap file opens every week.